But yeah, we're starting to see, credit spreads kind of, this is triple C to B, right? So this is the most extreme junk to junk. But so this is on the bad end of the spectrum of yields, but we're starting to see that kind of creep up. And again, it's not at a level right now that's of any, like, oh my gosh, I need to go get out of the market. But it's one of those kind of warning signs that we pay attention to, because again, if there's going to be an event, a market event of some sort, it's going to get reflected in credit spreads, and we'll see.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week with my good and Odyssean friend, portfolio manager, Lance Roberts. Lance, how are you, buddy?
I'm doing great, doing fantastic.
Good. Well, I chose Odyssean, as folks probably guessed, because you have been traveling home after your adventures in the Mediterranean, just like Odysseus. How was your time in Greece?
It was great. It was funny because we went to Italy a couple of years ago and we took all of our kids with us, and when we came back, we're never taking our kids with us on another trip. So we took our kids on this trip. We came back. We're never doing this again. But it was a great trip. It's a very long flight, just to get there. It took us almost about, with layovers and transfers and everything else, it took us right at 20 hours to get to Athens. We spent a day or so in Athens, went and looked at the ruins and a lot of the museums and things that were there, which were great. And then took a ferry, 2.5 hour ferry over to Mykonos, and which is an island. And that was interesting because, you kind of think of an island as really lush, it's green, and that is not the case with Mykonos. It is almost like Arizona. It's very dry and there's not a lot of grass, not a lot of trees. But it's very windy. It's always clipping off about 20-25 knots in wind. So it's very windy, which is nice because if it's hot, the wind is nice, keeps things kind of cool. But we spent a couple of days there. Food is fantastic. That was the best part of it. The fruits and vegetables are extremely fresh, and everything, Mediterranean food for 5 days is enough. But
I'm gonna guess you couldn't see your abs by the time you got home.
Oh, no. Actually, I did great. I'll send you pictures. But
okay. I'll just check out your
actually, I spent most of the time actually eating Greek salads, because they were so great that's really what I ate most of the time I was there.
Oh, nice. Okay, so anyways, a good time was had by all, even though you've sworn you won't do it with the kids again.
It's just so expensive. That's the thing.
Was it really? Okay.
Well, yeah, because the exchange rate, because the dollar has been getting a lot stronger, the exchange rate was not favorable. So it was running about 1.25 to 1 on an exchange. So it was inflation. So
I guess, although, I mean, I would think with a strong dollar, you would have better purchasing power over there. Like I've heard it's like, if you ever wanted to go to Japan, I hear that this is the time. Like
this is the time to go. Yeah. It was, like I said, I have no complaints about the trip. And I certainly encourage you, if you've never been to Athens, to look at the ruins and some of the other places in Greece. And you're interested in that, right? I'm a big history buff about Romans and Spartans and all that kind of stuff. So that's why I like Italy. That's why I like Greece. But if you're really into history and all that, it's a really great trip.
Yeah, I was an archaeology major, as I know we've talked about, and so I studied classics a lot, studied a lot of the history, and been around Europe a lot, seen a lot of great Greek statuary and whatnot, in British Museum and some of the museums are there. But I've actually never been to Greece, so I hope to follow in your footsteps. As you were telling me about the flight out there. It just makes me think of that old expression, which I think you are living, sadly, which is that no vacation ever goes unpunished. So not only do you have a 20+ hour flight home, right? So you're kind of exhausted. You kind of almost need a vacation once you get back from the vacation trip home. But in your case, I'm sure there was a bunch of work that had piled up, but also you're getting back to Houston, which was just walloped by Hurricane Beryl, right?
Yeah, no, it's funny because we're coming back and we're like very thankful, because we left like the day before Hurricane Beryl hit Houston. And we're hearing all these stories from our friends, and people are texting us like, "Hey, we're without power," and it's really kind of, it's like, oh well, we really kind of miss this. And it's funny because every time I leave town, normally the market crashes. So the good news is the market didn't crash while I was gone. That was good news. But we got hit with this power outage the whole time, and we actually came back on Friday. And our power, where I live in my neighborhood, people have been getting power back on through the week. We still didn't have power on Friday. So my wife's aunt has a ranch outside of Brenham, Texas, and we went and stayed there for through Saturday. We finally got our power back on Saturday, but there are still people, some very close friends of mine, that are still without power and may not have power until today, tomorrow, or Sunday. So it's been a really kind of a grueling couple of weeks for people
Because
here
it's
in
been
regards to power.
ridiculously hot down there,
Yeah,
right?
and yeah, it's been, well, thankfully, yeah, it's been close to 100 degrees, but thankfully we had some showers on Wednesday, Thursday of this week, kind of cooled things down a little bit, but it's going to be back into the 90s this weekend. So lots of anger at CenterPoint Energy right now, of course, because they're the ones that really kind of control all the power grid. But this really kind of goes to a story. We've talked about this whole need to upgrade the power grid and to increase capacity of power, especially for this whole AI generation. But this really is a bigger story that that now the governor of Texas is getting involved with. There's a lawsuit potentially being filed against CenterPoint Energy for this, because this was just a hurricane. This was just a Category 1 hurricane. This wasn't a Cat 5 like we had with Harvey back in 2017, right? This was just a Cat 1, and we had this massive power loss. And a lot of this has to do with the fact that CenterPoint Energy for years has been not spending the money to trim trees and to maintain power lines. And a lot of this damage was caused by trees falling, hitting power lines, knocking out power grids. Those things have to all get put back online. So it's going to be very interesting to see what comes out of this. But again, companies have been doing this for a while, cutting back on, and not just CenterPoint in general. This is for all companies that we've talked about. This whole kind of move to corporatism that's occurred over the last decade, which has been cutting costs, trying to increase earnings, increase payouts to executives, those type of things. Well, this is the consequence of that. And when you're a public utility, you have a responsibility to the citizens that really kind of go beyond just making profitability. And I get that, right? They've got to make earnings, they've got to appease Wall Street. But when you're running a power grid where the citizenry is dependent on that, you have another obligation that really goes above and beyond just pure capitalism or pure corporatism.
All right, so folks, we are going to get to the markets in just a minute, but I think we've talked about this a little bit before. There's an actual different term that's used to sort of describe this private equityizing of our services, even our municipal ones, like you're talking about. But the more polite term, I think, is the crapification of the economy, right?
Yeah.
And this is a small example, but I was back east last week, and thanks to your partner Michael Leibowitz, who stepped in for you while you were gone. But I was staying in an Airbnb, and fine experience there. But on the second day, I bumped into the owner of the Airbnb, and she asked how things were going. I said, great. I said, oh, but we noticed your refrigerator's dripping a bit in the back. Something was wrong with the condenser, and there was just the top shelf of the refrigerator was accumulating a lot of water, right? And she was like, oh yeah, the prior guest told me about that too. So I was thinking about having it fixed, but I think I'm just going to get a new refrigerator. By the time you pay somebody to come out and take a look at it, diagnose what's wrong, then order the part, then pay somebody to install it, so then you're pretty much having to, it's almost the price of another refrigerator,
Right.
And it's just, that's kind of the economy that we have now. And I think you and I have talked about this in the past, where things aren't built to last anymore, but they're so poorly built, and the cost of repairs and maintenance and replacements has gotten so high that we just sort of have this landfill economy, right? Where it's just easier just to chuck it and get another piece of crap that's going to, break before it's supposed to, right?
That's right. But again, it's going to be interesting to see how this turns out. But the big thing is that we just had just some big windstorms about a month or so ago, and we had massive power losses, and we're not even into having a real hurricane. Yeah, I mean, Hurricane Beryl, yes, it was Category 1, but if we have a
We're
real
not even in hurricane season yet.
yeah, that's the other thing is that if we have a real hurricane and Cat 3, Cat 4, Cat 5, what's that damage going to look like? So, I think there's going to be I think this is going to be kind of a come to Jesus moment for CenterPoint Energy, at least here in Houston, particularly with pressure coming from the Texas state government, as well as potential lawsuits, that there's going to have to be a lot of remediation done to fix what's kind of going on here anyway.
Well, it's interesting. I didn't really think there'd be another utility company out there that could make PG&E look good. Said as a California resident here, but you guys have had other issues with your power grid, right? I mean, there was
Oh yeah,
the loss of power in the winter just a few years ago, right?
right.
So maybe we'll talk about this in a little bit, but there's a high level comment to be made about the dilapidated state of a lot of America's key infrastructure, whether it's bridges, whether it's roadways, whether it's the electrical grid system. Now, a bunch of money is going into the grid, right, as part of the Green New Deal and everything like that. But the point you made earlier about AI is the demands of AI, the projected demands of AI are gargantuan from an energy production standpoint. And if you even forget about the AI story for a second, we're kind of challenged to build the grid we need just to run a modern economy. You lay the AI demands on that. I mean, I think it's pretty fair to say we don't really have clear line of sight as to how we're going to come up with the power for all that on a near enough time scale, right? And people say, well, we'll just adopt nuclear and whatever, and great, right? But that's going to take a long time.
Yeah.
So
10
anyways,
years.
we're going to be very energy constrained for the next decade plus, and I think folks need to just sort of prepare for that. And maybe that's an investment theme, Lance.
Yeah, no, it is. And we've actually been adding that into our portfolios. We've added some natural gas producers. We've added in utility companies that are specific to regions where data centers are mostly hubbed, because that's from an investment standpoint. There's going to be we think there's a real long-term opportunity there for revenue growth.
Great. And look, I don't want to talk about this because I'm not up to speed enough on it, but I was just looking at a company, Sam Altman, the OpenAI founder. He is backing a nuclear company that is very much these sort of small modular reactors.
Right.
That seems to be making a lot of progress relative to the past couple of decades of trying to get new designs and approvals through the system. And it could be really interesting to see and it's a publicly traded company. Not a recommendation, but for those curious, the ticker is OKLO. Just something you might want to check out. But Lance, we might want to talk about nuclear in a future video here about the investment prospects of it and when the timing might be right to start adding that into portfolios like yours.
Yeah, the problem with nuclear is not just the function of building the plant and getting it operating. And this is and we won't get into this, but this is one of the big problems with whenever somebody talks about nuclear, they immediately go out and buy uranium investment, right, on the commodity side. The problem is that's the last phase of what you need for generating nuclear energy. That's not the first thing. So it takes such a long time to build a nuclear plant. It doesn't take that long to build the plant. I mean, that takes 2 or 3 years to actually build a plant, but it's all the regulatory approval process, right? And with what's going on with the administrations and the gridlock that we have in Washington, et cetera, the licensing, the permitting, the regulatory environment, all that could really make these stretch out. Yeah, it could stretch out to 8 to 10 years to get a nuclear plant built, and the demand for uranium isn't until the end of it. Right. So,
and by the way, 8 to 10 years is like lightning fast.
Yeah.
So to date, yeah.
Exactly. And so, that's the problem with the whole trade. And look, do I think nuclear power is going to be a major component of our future electricity generation? Absolutely. It may not occur in my lifetime, though.
Yeah, I'm going to be a little more optimistic than that, but the answer is who knows. And folks, if you're interested in kind of a deeper dive on this before Lance and I get to it, there are some interviews I've done online with a guy named Justin Hune, who runs the Nuclear Research Service Uranium Insider. So if you just type in Adam Taggart, Justin Huhn, Huhn, those should come up. But we kind of do a pretty deep dive into the state of the technology and where things are.
Yep.
One of the things that might change this, Lance, beyond just the fact that nuclear is all of a sudden suddenly getting embraced as a green energy source, because folks are waking up to the fact that given our goals, it's really kind of the only way that's going to help us get to these goals in any kind of timeline.
Right.
These small modular reactors have promise in a whole bunch of ways, both in terms of safer ways to produce nuclear energy and all that stuff, but they're smaller, so their footprint is a lot smaller. So therefore, the regulatory red tape and all that stuff is less, because you have less impact. The other big difference is that in the States at least, every nuclear plant that we've had to date has been a one-off custom build. We've had to kind of reinvent the model every single time, where if you have a small modular reactor, it's modular. You're building on a template every time round. So you get efficiencies, you get economies of scale, all sorts of things like that can dramatically shorten production times and all that type of stuff. Now, will this all come together on a timeline that matters in our lifetime? TBD. We'll find that out.
Yeah,
but,
that's my point, which is
yeah.
there's no way to tell, but
there's no way to tell. But I do think back to Doomberg's comments, which is it's a lot easier to you can change a political constraint much faster than you can a geological one, right? And a lot of what has held up nuclear in the past, to your point, has not been science; it's been political, right?
Yeah.
So,
no,
anyways,
absolutely.
TBD.
Mining uranium, there's a ton of it out there. It's just getting all the other processes put in place.
Yeah. Okay. Look, sorry, folks, didn't mean to make this a uranium themed discussion here. So, Lance, I thought you were gonna start this video with, "Hey, I'm back from Greece. So, what I miss?"
Yeah, right? I could have. I could have done that. Yeah. Anything
so we
time?
didn't have a market correction while you were gone, but we did have an attempted presidential assassination, right?
Yeah.
Or presidential candidate assassination.
Yeah, I did come back to that on Saturday too, so that was interesting.
Okay. Yeah. So let's talk about that just for a second,
Sure.
for a couple of reasons. And a big one is the other night, Bloomberg published an interview with former President Trump, where he outlined the key tenets of his economic plan. And I'd like to walk through those tenets with you just to get your reaction to how you think those might change, the game from an investing standpoint, should Trump get reelected in the fall. But I do want to point out that you made a comment the other week, which I'm not sure everybody agreed with, but it's held true so far, where I asked you, hey, if they replace Biden on the ticket, because we were talking after the presidential debate, would that be disruptive to the markets? And you basically said, nah, not really. And what's been interesting is we had this, incredibly disruptive to, the nation's psyche event of the attempted assassination of candidate Trump. And the markets really didn't do very much. Now, they did some interesting things this week, but it wasn't in reaction to that, right? So,
right. Yeah, no, and what's interesting is what's always interesting to me is and this is a function of human nature, right? Is if I take a paintbrush and dip it in a bucket of paint and I splatter it against the wall, right? You get just a whole bunch of drips and dots and everything else. And if you stare at it, your mind will start trying to put together a pattern out of it. It's like, oh, I see a face or whatever inside this just splattering of paint. And this is the way we are as humans. And so when we look at the markets and the markets do something, immediately we start looking for, well, what caused that? What was the driver behind that? What was the catalyst? And of course, the media is the worst at this, right? Is like, we have something that happens and the market's up or down in the morning or in the afternoon or whatever. And then the headline is markets are down because of, A, B, or C that happened, right? Trump said this, so markets are down, or Biden said this, so markets are up. And that's really not what drives markets at all. It's not these headline events. One of my best stories to explain this was back in 2000, just as we were starting to go into the dot-com crash. And IBM came out that morning and laid off 5,000 people, and the market was down sharply that morning. And so the media headline was, markets down sharply as IBM announces 5,000 layoff. Now, that kind of makes some sense, right? I mean, if they're laying off 5,000 people, must be something wrong with the economy. Well, that afternoon, the market completely rebounded and was up like 1 or 2% by the end of the afternoon. And the headline read, market up 2% as IBM lays off 5,000 people. So, it can't be both, right? But this is just, as humans, we're always looking for that reason as to what's going on. So why are the markets correcting this week? Well, we've been talking about this for the last 3, 4, 5, shows I've been on with you. It's like, we're due for a 5 to 10% correction. We're getting into the right time of the year, late July, August, September, October, pre-election. And the market needs to correct just to have a healthy correction. And as of this morning, as we're talking here on Friday, the market's kind of violating that 20-day moving average. This is the first test of the 20-day moving average we've had for the last few weeks. So this is just a normal, healthy correction within the market. It needed to happen. Yes. You can attribute some media headline to it that maybe got sellers to stand up and go, okay, I'm out, I'm going to step aside for the moment. But a lot of this is really just the function of a hedge funds got caught on the wrong side of the trade. Hedge funds were extremely leveraged in big mega cap stocks, and they were heavily leveraged in short small cap stocks. So when this presidential assassination attempt occurred, the immediate assumption was that this is going, and you have that iconic picture of Trump, leaving the stage. That shot a message to the market that, oh my gosh, Trump may actually win this thing. What's the right trade for this? And this caused just this massive, off the shoulder rebalancing of portfolios. Selling long mega cap, having to cover in a big way all the shorts on the small cap index. And so you saw this massive rotation in the market. It seems to be over now. Yesterday, small caps, mid caps underperformed large caps. It's happening again today. So, it may have just been a flash in the pan. We'll see. But this is really just that correctional process that we've been talking about for the last several weeks, just starting to take shape.
Okay. I got a couple of questions about this. One is it just the correctional process? To borrow a recent comment from the media, is this an episode or is this a condition, right?
Right.
In other words, is it just the correction that needed to happen? A little bit of froth is getting taken out of here, or is it a material rotation from big growth companies into smaller caps? Because if it's the latter, you could argue that's pretty healthy. That's what we've been waiting to see. We've been complaining forever about how narrow this market is and how bad its breadth is and all that type of stuff. I'm going to guess from your comments, too early to tell, or do you have a more strong opinion?
Well, it is. It's too early to tell, first of all, but there are some problems with the narrative that small caps are about to take the lead. I saw a couple of articles written over the last couple of days. The AI bubble is done, and this is the new cycle, and it's going to be small and mid caps.
Yeah. And by the way, I do want to talk in this conversation about the risk to the AI bubble, but keep going.
Yeah. And there's certainly, and look, the risk I'm about to lay out to the small and mid cap thesis is there's a sister story to the AI issue, right? So specifically what you're talking about, there's a risk to that whole AI narrative. But here's the big problem with the small cap trade at the moment. And I'm not at this moment today, I am not convinced that small caps and mid caps are about to take the lead. They may. And if we see that rotation start to gain some legs and see some sustainability of that trade, again, 2 or 3 days does not.
Right, a trend make.
Right. We've seen these before, that we've had these episodes for the last 3 years in the Russell 2000, and then they completely fell. Is this going to be the same? We'll see. But there's some problems with the whole small cap, mid cap narrative. First of all, 40% of those companies are non-profitable. Small and mid cap in particular are extremely economically sensitive. That's where their earnings come from. And so as the economy slows down, so do their earnings. So right now, and if you just take a look at earnings estimates for the small and mid cap companies, they were very optimistic going into this year. And in the first, second, and third quarters so far, those estimates have been ratcheted down sharply for those. In fact, those companies are now just expected to barely show profitability in the first 3 quarters. Now, there's a big hope, there's a big hockey stick for quarter 4, but you got to say, well, where's that earnings growth going to come from? Are we about to have a massive economic rebound in the economy and grow at 3 or 4% through the end of the year? Maybe. I mean, that's possible. And if that occurs, then we got a story for small and mid caps. But small and mid caps are extremely dependent on economic growth for their earnings. Furthermore, these companies do not have the capability to execute large stock buybacks like the mega caps do.
Right.
So they don't have the ability to support their EPS and their stock price by doing share buybacks. And lastly, if you take a look at the breakdown, again, we've talked about this whole passive indexing, mindless robot situation before. 35 cents of every dollar that goes into the market goes into an S&P index, goes into those 10 stocks, Microsoft, Apple, Google, et cetera. The problem with the small and mid caps is they're basically mostly equal weighted. The heaviest weighting in like a mid cap index is like 0.5%. So when money goes into those passive ETFs, you don't get the same dispersion of the, or sorry, excuse me, you don't get the same concentration of dollars going into a handful of stocks in the small and mid cap space. So you don't get the lift from that passive indexing, kind of issue. And just as a function, most investors are invested in large cap stocks, hedge funds, et cetera. Most of that is focused on large cap companies because they need liquidity. I've got to be able to allocate hundreds of millions of dollars at a time. I can't do that in small and mid cap stocks. So that's why a lot of your hedge funds and pension funds, et cetera, all say focus primarily in that large cap space because they have to for liquidity and other issues. So there's a lot of headwinds to the whole small cap, mid cap story that if you're going to make that bet that we're about to have this major rotation from large cap to small cap, that's going to be you've got to answer those questions. One last thing, and I'm going to turn it back over to you, Adam, is that over the last couple of days, the one thing I heard was, well, it's because yields are falling now, and that's beneficial to the small and mid cap companies. Well, the problem is that story really isn't true. And if you just take a look, for instance, just in recent history, and I'm going to share a chart with you real quick, but just in the recent history of the last year or so, when yields previously fell last year, and we had that decline in yields going into October, mid caps got crushed. Now yields are falling and mid caps are going up, and we're going, okay, well, they're going up because yields are going down. Well, there's really not any historical precedent that suggests that. In fact, I built this chart, and I'm actually writing an article on this for this weekend's newsletter. But this is the 6-month rate of change of U.S. Treasury rates versus the Russell 2000 6-month rate of change, and the correlation is actually much higher. That when yields fall, small and mid caps fall with it. Why? Well, yields are falling because economic growth is slowing, inflation is declining, which detracts from their ability to generate earnings. So we've got this little bit of an anomaly as shown in that little red square on the right-hand side. But historically speaking, the risk is to the downside. If the Fed starts cutting rates and yields are falling because the economy is slowing down, the risk is really to the small caps, the small cap space more than large caps.
Okay. So my only question on top of this is, I think that the narrative is, hey, yeah, we're now maybe having this big rotation, and S&P is still going to get to 6,000. It's just that the large caps are going to pass the torch to the small caps, right? Mm-hmm. And you've just given a whole litany of reasons, why that might be challenging. Right. But if the large caps aren't doing well, in fact, if they cool off a bit, we could easily have a scenario, I think, where the small caps actually do rise in price, but because the big cap stocks are such a big percentage of the market cap, if they go down, you'd still have a declining index, even if the small caps do well, right? So you can have the small caps do well and still not get a payoff in the general index itself.
Well, yeah. Or what'll happen is that we'll have a market environment where, and again, you and I have asked this question a lot of times, which is what causes people to go sell their ETFs, right? That's the big thing. Yep. What gets people out there selling their spiders and their diamonds and their Qs and those type of things? And I don't think we've got that story right now, but you could have an environment, and again, we saw this back during the dot-com crash, where the large cap stocks really fell apart. Small and mid caps fell also. They just didn't go down nearly as much as the .com stocks, right? So from a portfolio management perspective, you were better off being overweighted in small and mid caps
Sure.
during that period than you were large caps. However, that whole story goes is that, if you take a look at, how small and mid caps have performed over the last decade, you've lagged large caps by such a tremendous margin that, it's almost impossible for small and mid cap performance to catch up to large caps at this juncture. So, look, I don't have any idea how this works out, right? This is, we own some small and mid cap stocks in our portfolio. We've done well over the last week because our portfolio was structured. Yes, we own some of the mega caps. So we own Microsoft and AMD and Google and NVIDIA and Amazon, but we also own a lot of other boring companies like Visa, Berkshire Hathaway, ExxonMobil, Costco. And so that rotation within the market helped our portfolio do a lot better than the overall market. If this rotation continues and we continue to see better performance in small and mid caps, we'll also continue to reweight the portfolio. We sold down AMD and NVIDIA on Tuesday before the big hit occurred on Wednesday, and then we reduced a lot more of our portfolio day before yesterday, before kind of this kind of market sell-off over the last couple of days. So we've already been reducing risk and raising cash to some degree. And again, we'll look for this where this bottoms, and look for the opportunity to put some capital back to work. And I guess it's just as good as opportunity as any, just to review the chart real quick. But you can see.
Just to let folks know, it sounds like we got a lot of trades to talk about at the end of this video, and we ask what you've done over the past couple of weeks while you were on the road.
Yeah.
But what I don't hear you saying is, hey, we're shifting our balance between large cap and small cap.
Not yet.
Not yet. Yeah.
Yeah. And again, just because there's not really any reason to at this moment. Look, just as an example, if I was a guy that said, hey, I've missed, let's just say I'm a portfolio manager, I'm a big large cap fund manager, et cetera, and I'm underperforming this year because I didn't own NVIDIA. This is my opportunity to come in and buy it. And I don't be surprised if you don't see some buying come into these big mega cap stocks over the course of the next few weeks, because this is the first decent opportunity that portfolio managers are going to have to come in and buy some of these stocks that they've been missing in their portfolio, where they've been lagging performance. Only about the percentage right now, last time I checked, and it may have changed a bit, but the last time I checked, there's only about 18% of large cap managers actually beating their benchmark this year. So there's a huge swath of portfolio managers that are lagging the index, and they need to have this exposure if this large cap trade, picks back up again. So, so again, don't be surprised that you're having this correction, because it was vastly needed. NVIDIA was almost well into 3 standard deviations above its long-term moving average. So this correction back to its 50-day moving average is very healthy. It's getting very oversold on multiple levels. So if I'm a tech buyer, or if I'm a large cap tech company, or a manager, or if I'm just looking to add some tech exposure to my portfolio, this is the first really decent opportunity you've had since it corrected back in March, April, May, right? So so this is, it's always important to keep narratives in check. That, and again, and we're seeing this kind of across the board. AMD's had a nice correction here. It's sitting right on major support, right at the 200-day moving average. Microsoft is finally giving you a little bit of an entry point here. Apple as well. You haven't seen, decent entry points for a lot of these stocks in quite a few months. And so I think you're going to see some buyers starting to come in here at some point to start to pick up some of these shares at better prices.
Yeah, well, you either will, or Sanford and Son, Red Fox. This is the big one, right?
Well,
but if it's not, buyers will come back in.
Yeah, well, there's really nothing wrong with the markets. Again, there's not any major impending news in the markets. There's not any type of real concern over earnings at this point. The economy's certainly slowing down. We saw that with the retail sales report this week. On a non-seasonally adjusted basis, retail sales were down about 5%. So,
Although on a seasonally adjusted basis, they
They're flat.
surprised to the upside.
Yeah, they were flat. That was better than expected.
Yeah.
It wasn't great. But the economy's definitely slowing down, right? And we're seeing that. But again, there's nothing out there at this moment that says, oh my gosh. For instance, you're seeing a lot of headlines right now about the AI trade is over. Yeah, there's some headwinds to it, but there's nothing that says all of a sudden companies just woke up and go, yeah, I'm not spending any more money on AI. That just hasn't happened yet. So
although let's talk about that in just a minute, but you're right, it hasn't happened yet. Let me ask a question here just based on the chart. So
sure.
You have been saying for a good long while, hey, this market's too overbought and we're going to have this correction, right?
Right.
Said it many, many times. And now we're seeing it cooling off here. We have broken, is that the 20 daily moving average there?
Well, now remember, this is Friday, and we're looking at this chart real time on Friday. So we're at 10:33 Central Time. We are below the 20-day moving average. Now, this market could well rally back at the end of the day, and we'd be back above the 20-day and holding that support. But assuming the market closes right where it is right now, this will be the first real challenge of the 20-day moving average that we've seen since really going back to May 24th, which is where we had the last kind of challenge.
Yeah, and that's where it really did sort of serve as support, right? It bounced back off that pretty quickly.
Right.
So let me ask you this. Just asking your gut feel here, and I'm not going to hold you to this, but if you look at the MACD and if you look at the RSI, they're now descending, and they're descending from very high overbought levels.
Right.
If we close here and then maybe even had another down day next week or so, beginning of next week, what does your gut tell you? Would this thing play out further and we'd be likely to go down to the 50-day moving average, or I don't know. I know I'm asking you.
Well, no, it's a great question, because we've got two opposing issues that have occurred this year to date. So where we are right now, you have the MACD flipping over to the downside. You have RSI coming down from a fairly elevated level. Last time we had that occur was back over here in December of last year. And we saw that very same kind of flip over from a high level. RSI was high and the market just kept going. And the MACD just flipped back and forth. The market kept grinding higher right along the 20-day moving average. And we worked off that. We just kind of held at this very overbought level for a period of time. Now, going back to June of 23, we had the same type of signal here, flip MACD from a high level. RSI was very overbought, and we had a decent correction. We took out the 20-day, then we took out the 50-day, tested the 100-day, bounced, and then came down to test the 200-day moving average. That's this environment that we saw in June of 2023, I think, is a similar possibility of what we could be seeing. Historically speaking, going into the election, markets tend to de-risk because you really don't know. Yes, right now, if you take a look at a lot of the polls and a lot of the commentary that's out there, it looks like Trump has a very good chance of winning the election in November. So some of this may be positioning for that potential victory, but this is not the first time that we've seen this type of thing stack up. And then there's what's called the October surprise, and somebody pulls something out of their hat for the Democratic side that all of a sudden shoots them up in the polls, and they wind up winning the election. The incumbent tends to win the election more often than not if you're not in a recession, and we're not in a recession. And the markets are doing well, which also bodes better for the incumbent historically. Now, we have a challenged incumbent at this point. And and there's some rumors they may replace him over the weekend with Kamala Harris. Her odds have been rising in the polls right now that she'll be the actual candidate. We'll see, but something could happen to change that narrative. So portfolio managers tend to de-risk in August, September, October because they don't know the outcome of the election for sure. And so historically speaking, you tend to get corrections, particularly in September, October, for that period. So, looking at seasonality historically, looking at how overbought and extended the markets were, that, I think we could well see something like we saw last year going through October, where, this market is working through some of that digestion of the recent rally, working off some of these kind of overbought conditions that exist in a lot of these companies, and then kind of de-risking for that election. Now, post the election, I think you see exactly what you saw here. As soon as the election comes through, we know what we're dealing with. Trump gets elected, we know it's going to be lower taxes, tariffs, a real kind of push for immigrating manufacturing back into the country. Same playbook we saw during his previous tenure. The market will trade off of that. If Biden or Harris or whoever it is actually wins the election, we know what we're going to get. It's going to be more government spending. It's going to be, kind of a push for infrastructure on the green energy side. So those trades are going to take off very well. So again, I would look for a very strong rally in November, December, coming out of whatever correction period we get, if it plays out the same way. Now, just having said all that, anything is possible.
Right. Right. And on that point, I'm just going to mention it now so we can revisit it in a couple months. I think you and I talked a month or so ago about a thesis I have that there's a personal interest in either candidate right now to kind of let the froth come out of the markets post-election. Mm-hmm. And I was mentioning this to Anna Wong, who is Bloomberg's chief economist, to get her opinion on it. And she said, hey, there's actually something called the Rayfair election rule. That basically says that when you have a change in administration. So it'll be interesting to see. I was like, oh, I feel validated that there's actually a rule around this. Who knows what's going to happen, but it'll be fun to Monday morning quarterback, whatever happens. All right. So let's see here. So obviously we'll be tracking, on a week-to-week basis, what's happening here in the markets, and you can tell us as a pattern emerges whether you think it's more like what happened last July or whether it's more of a head fake. All right, so I guess from here I want to go next to the visiting. Should Trump get reelected, and as you said, the predicted markets right now have him winning more or less in a landslide. Of course, anything can happen from here. Mm-hmm. But assuming he does, I just want to take your temperature on what you think the economic and then potentially financial market impact of his main policies would be. So here's a quick summary. Probably the biggest one is tariffs, where Trump would enact tariffs to a much higher degree than we're currently doing right now. I guess we'll start there. The long-term impact of that could be strength of American companies, but a lot of people are saying this would be inflationary. What type of impact do you think a new and aggressive tariff regime would have both in the economy and the markets?
Well, there's certainly obviously if you impose tariffs on goods, and again most of these tariffs can be targeted at China for just a variety of reasons, that's going to increase the cost of those products that you're importing into the U.S. And so in theory, the economists are right that should be inflationary. But we've done this before back in his last term, and inflation actually fell. And the difference is that now versus the way it was back in the 20s when we had Smoot-Hawley and all that going on with tariffs back then, is that the world is very global now. So if the product from China is too expensive, we just order it from somewhere else, right? One of the issues that we have with current globalization, and this has been one of the big fallacies of people expecting inflation to go through the roof forever, is that we don't live in the same environments that we lived in previously. And so we export inflation to other countries. We import deflation through what we buy. And so we'll all, and as consumers, we're always looking for the best deal on things, right? How can I get things cheaper somewhere else? So I go online and I search, I should say, let me correct that statement. We look for the cheapest thing to buy when it comes to anything other than stocks. Then we buy the most expensive thing. So,
yeah. We want to make sure it's trading at an all-time high before we buy it.
Correct. But when it comes to most things, right? We shop for cheaper cars, we shop for cheaper mortgages, we shop. If I'm looking at a television, I search through 15 different types of televisions to find the cheapest one. So we import deflation through that process. So tariffs didn't show up as an inflationary force in 2016 through 2020, right? So that's, I think we have to look back at recent history and understand that, sure, could tariff, it depends on the extent of the tariffs that he imposes, how aggressive they are. But when you combine those tariffs with tax cuts, that's going to potentially, create stronger economic growth, and then will potentially lead to, better outcomes for the markets and those type of things. So, the policies are decent, and I don't think they lead to a big, massive spike in inflation simply because of globalization.
Okay, and
We'll see.
just,
I could be wrong.
yeah, and just to remind folks, we're not political analysts, so that's not our area of strength. But we have to be mindful of where the political puck may be headed, because it does have implications in the economy. So
And also just real quick,
yeah.
just remember that these policies all sound great. None of it may happen. If he wins the presidency but doesn't win the House and the Senate, all these policies are dead. He'll never get tax cuts done. He won't get tariffs done, because all that's got to get passed through the House and the Senate. So the vast majority of these outcomes are going to depend on who wins House and Senate.
True, which I think is one of the reasons why at least the current headlines are suggesting that Biden's getting so much pressure from senior leadership, like Pelosi and Schumer now, because they're beginning to sweat they might lose Congress. Right.
That's right.
All right. So let me ask this question. Again, this is we're speculating politically here, but so Trump just announced his. Oh, sorry. Before I mention that, I got to mention. Yeah, none of the stuff might happen. I was listening to Trump's speech at the RNC last night, and he made a lot of bold and brash promises, as every politician running for office did. But one just really, it was a pill I couldn't swallow. And he was like, "And we're going to reduce the debt." And I was like, "Really?" Like, if you claim the deficit, I really doubt you would, but I could see that you could reduce the deficit spending a bit, right?
Yeah.
But to actually reduce the debt, and he specifically said the 36 trillion of national debt, right? I was like, that is a gargantuan amount of pain that I can't imagine any living politician wanting to do. And by the way, no politician has done it across their administration in my entire lifetime.
Right.
So some of these promises are just, not going to be fulfilled.
They sound great on paper, but the realities are different. Now, look, there are a couple of things he could do to reduce spending and the deficit. There's $500 billion that hasn't been spent in the Inflation Reduction Act that's still sitting out there to be spent.
Yeah.
You could claw all that back and not spend it, right? That would be an easy $500 billion to clip right off the top. There's a lot of other spending and things that goes on with government. Look, he could save a tremendous amount of money just by culling off a lot of the excess in internal expenses in running Washington. Just focus your spending.
He could just set Vivek loose with his chainsaw, plan.
Right? Return a lot of the, like Department of Energy, Department of Education, return those back to the states. That's where they belong anyway. So, you're cutting billions on spending out of those organizations.
Right. Although that, just to be honest, because I had to look at this last night because people were suggesting all sorts of ideas.
Sure.
That is, largely crumbs relative to the big three, right? Social Security, Medicare, and
you're not going. And look, and nobody is going to touch those things.
Yeah.
Right. And you can't look, you can do a lot of things going forward, stop putting more and more people onto those payrolls, right? That don't really belong on Social Security and Medicare. That was designed for a specific reason. It's become a honeypot for, every egreged, group of people. We say, okay, well, put them on Social Security or Medicare or Medicaid, whatever. Stop that, right? So you could slow the spending dramatically going forward, but no, you can't go back and we're going to take money away from people. That's just that's not ever going to get passed. It's not going to happen.
Right. Although that would be a good maybe rant sometime. Like let's put ourselves in the czar chair and just say, hey, if we literally had to make these things economically sustainable over some period of time, what would we do? But that's not today, because that's too long of a conversation. So my question for you, still sort of on this tariff side of things, is so Trump picked as his vice presidential candidate JD Vance. who presents himself as very much of sort of a populist. I'm here to represent the working class guy. He wrote Hillbilly Elegy. I kind of grew up in that world, and seems to be very worker friendly and very supportive of reshoring and really not even anti-union. So it seems like part of the platform is, yeah, we're going to bring a lot of jobs back home. Trump, especially in his first administration, very anti-NAFTA, has worked to try to undo parts of that. So in addition to tariffs on China, I mean, we very well may be just saying as a nation, hey, we're going to shift a little bit to not buying the cheapest thing from the lowest producing country, and we're going to start producing more from here, and that's just going to make products more expensive because American workers are making them. And I'm not saying it's good or it's bad. I'm just saying American workers are a lot more expensive than somebody working at Foxconn in China, right? So we may have kind of a bid under inflation going forward. The Fed's 2% may not be realistic.
Maybe, and that's certainly very true. The problem though becomes that people just can't afford it, right? And at the end of the day, people are barely making ends meet the way it is right now. Bottom 80, 90% living paycheck to paycheck. So if you start increasing goods without increasing wages, that's going to be an issue.
Well, I think they will. I think that's part of their thing, which is again, all political sound bites, but let's increase wages for the working guy and, maybe stick it to the Wall Street elites, which never happens.
Well, the problem is that didn't happen before. So let's go back to 2016, right? So back in 2016, he comes down the escalator, takes over the presidency, and first thing he comes out, starts pounding the table, right? Remember, he's calling up all these CEOs and getting them into Washington saying, you need to bring jobs back to America. We need to make America great again, right? Awesome. Great job. Carrier Industries was one of the first ones to jump on that train and said, yep, we're going to move our plant from Mexico back to Indiana. And so, of course, that was in all the sound bites. Well, about 3 months later, Jim Cramer interviewed Greg Hayes, and they said, hey, you're moving this plant back to America. He's like, yeah, but let me tell you something. He said, first of all, the workers in Mexico, they're diligent. They show up. They don't ask for time off. They're in 6 days a week, and we pay them $5 an hour. And they produce well. When we move those jobs back to Indiana, yes, we're going to do that, but we can't increase our costs, right? Because we can't sell products. So what we're going to have to do is automate that entire plant. So, and that's exactly what happened. They got about a $25 million tax grant, tax credit from Indiana to move their plant there. They automated most of those jobs. Most of those jobs were lost. So again, the reality comes down to the very basic economics of supply and demand. It's great to think that you're going to move back a lot of jobs to America, but the only way you do that is either to suppress wages or automate them because people can't afford the product.
Right. Or
no, there's no or to it. That's it.
Well, no. So, but it's not binary, right? It's like the Americans don't just stop buying everything. So what might happen is they might just say, look, we're making American products more expensive because they're going to be made at home, but we're raising tariffs and everything else. So everything else is even more expensive, and you will buy less, right? And the outcome of that is your economic growth takes a hit, right?
Exactly, which is also disinflationary. I mean, that's my point, though. And that's what I'm saying. There really is no but. No matter how you come out of this, unless you are somehow able to drastically increase the wages of the American worker, which again goes right back to the profitability of companies. Okay, so now what's their inclination to drastically increase their wages, which is the highest cost of any business?
Right. They have to be making more profits. Yeah, which is
right.
Good. Yeah.
And they're being demanded by Wall Street to generate more profits. Their only avenue is to increase productivity per worker, which is through automation, artificial intelligence, all those type of things,
which results in less jobs. Yeah,
correct. And then so that's what I'm saying is like it's almost like you want to put a sign up that says it's a trap, right? This whole idea of onshoring America and all this, it sounds great. But the only way to do that is you've got to make wages competitive to everywhere else in the world. This is why everybody outsourced jobs, right? Because I had to outsource jobs to manufacture products cheap enough so I could sell them. And so the only way to bring manufacturing back to America is you've got to make wages competitive with every other place on the country, or in the world. So either you slap massive tariffs on everybody else in the world, to equalize the wages here. But then if you start increasing wages, then you got to keep increasing tariffs, and then that causes all kinds of other problems. So,
Right.
this is a real, the whole tariff thing. I don't think he gets, I think he'll be able to manage. I think he'll be able to onshore some manufacturing, but I don't think it's going to be this industrial renaissance that a lot of people are thinking it's going to be.
It's going to be interesting, and just to note, folks, for a really deep discussion into this topic, go look at the video I've done with Michael Every. He has really been predicting this, that the world's going to become much more mercantilistic, which really is all about sort of protective tariffs and, my country first. And all I'll say is what we're talking about is straight from that script. Whether this happens or not is still TBD, but this is what Michael has been saying for years is where the world is heading to. All right, so let me bring this thing back up again. So the next point was, he kind of gave us some signaling here to the Fed. He said, all right, Jerome, I'm not going to try to remove you from your position until your 10 years up in 2026. But, you wouldn't want to be monkeying around with policy prior to the election, right? That would be a bad thing to do, right? So kind of put some pressure on him that, like, hey, if you do any rate cuts before the election, maybe I'm going to break this promise and try to get you out of your chair, which would be really hard for the president to do. This goes back to our conversation from 2 weeks ago, Lance, which is, can the Fed cut before the election because it doesn't want to be seen as trying to influence a political election, right? And given Powell's recent statements and the recent inflation data, I think at last check, there was like a 95.3% chance, or the market was assuming a 95.3% chance that the Fed will cut in October. Sorry, in September.
Actually, September.
September, yeah, in September. So, we have, and just to add one more thing to this, I did a live Ask Anything Q&A event 2 days ago for my Substack audience, my premium Substack audience, with Thomas Honig, the former St. Louis Fed CEO and member of the Federal Open Markets Committee. And he strongly feels the Fed should not cut before that, not for political reasons, but just for trying to achieve its goals. So we have all this dust up in the air now, where Powell has been sort of hinting, I think we might be able to cut sooner than possible, but we're getting into that window where the closer we get to the election, it looks like a political maneuver. And now Trump has come out and said, hey, buddy, I might be in charge and I'll be pissed if you do that, right? And when I asked Honig about that, he said, the Fed tries to be independent, but he said, look, those voices are loud, in the Eccles building.
Yeah, they are. And there's a possibility he could cut at the end of this month, right? I mean, the recent inflation data was weak enough that, there's the odds, the Fed fund futures don't suggest he will cut in July 31st meeting, but it's possible. If you want to cut rates and not be seen to influence the election, the end of the month would be the way to do it. So, but again, to your point, the Fed fund futures right now are giving the Fed kind of a green light to cut in September, saying, yeah, we almost 100% think you'll do it. So you've got the green light to go and do it. Remember, that's really at the end of the day, the markets are kind of the judge and jury of Fed policy. So the market's agreeing that they can cut. We'll see, we'll see what happens.
Yeah, sorry, I just got a comment on that though, because for the past, since January of 2023, the markets have always been expecting the Fed to cut in the near term, and the Fed hasn't. So judge and jury, I don't know. The Fed has ignored them for the past year and a half, and it hasn't mattered. Stocks have still gone up.
Right. No, what I mean by judge and jury is they're saying, look, what Fed fund futures are, they kind of portray out what the market's position is. And like, if they're like, don't cut rate, like there's no chance for a rate hike or rate cut in March, as an example, and then they come out and cut rates in March, you get a big surprise event out of it. What I'm saying is that what the Fed fund futures do is they either kind of green light or red light the Fed, so they can say, we're okay with it. If you want to cut rates in September, we're good with it. That's what they're saying, right?
Okay. All right.
Now, whether or
you're
not
saying like we're not gonna go ballistic on yields further out on the curve if you were to do
correct.
that.
Exactly. So, I mean, that's what I'm saying is like they're giving them the approval to do it. Again, whether or not they do it in September, I don't know. Again, it is pretty close to the election. I think it could be seen to be kind of influencing the election. I've said that for a while. But I think a lot of it really depends on what happens with the economic data in August. If we see another big drop in inflationary data in August, we see a big drop in employment, anything like that. Jobless claims were up above 240,000 this week. So we're seeing some definite deterioration. Temp work is slowing down sharply. We're certainly seeing a lot of this economic backdrop beginning to weaken. So if you see another kind of big deterioration, I don't think the Fed's going to have any choice but to cut rates in September, because they don't want to get too far behind that curve. If they wait too long and the economy really kind of, the rubber hits the road, so to speak, now they're going to be forced into cutting rates by half a bip or 75 bips, trying to play catch up. And I don't think that's where they want to be.
So that's history, right? Which we've
Mhm.
talked about a lot, right? Which is for each of the past recessions, basically in living memory, that has been preceded by the Fed hiking rates, plateauing, and then unemployment very quiescent all of a sudden to the point where it's not, and it starts spiking super high, and then the Fed is scrambling to panic cut, right?
Right.
So something would have to be really different this time. And of course, if inflation was at 2% or less, it'd be easy for Powell to start cutting now and saying, oh, I want to pump the brakes right before too much downward momentum takes place. But he is constrained by inflation. Now it's getting better, as he's been saying, but we're still in the threes, right? So, it's risky for him, I guess is what I'm saying.
Yeah.
I just pulled up the continuing claims and initial claims here, and I'm really resisting the urge to start taking an early victory lap, and I'm not going to. But I've been saying, it says Michael Cantro for the past 2 years, it's all about the E. It's all about what happens with employment. And we've been talking a lot about how hard to swallow a lot of the unemployment data is, and that it is either very doctored or just very distorted from the bullwhip effect of the massive distortions to unemployment during COVID that are still rippling through the BLS's models. But anyways, if you think that this is some of the ugliest data that the government puts out to try to make the jobs market look better than it is, they are losing control of that, right? We're starting to see these numbers go in directions that the Fed and other central planners don't want to see. Now, they're still at not worrying levels at this point, right? So this is not time to pull the alarm bell. But this is the type of these are the early warning signs that we would expect to see if employment really is starting to worsen. And not for nothing, Jerome Powell has mentioned this in his past couple of press conferences when the press has asked him, hey, because they're always looking for him to cut, right? So, hey, what would get you to cut sooner? And starting 3 press conferences ago, he started slipping in, if the labor market started to really have some issues. And he's been talking in the past couple press conferences about the labor market data, quote, normalizing, which, in his mind is getting less tight, but you could also say worsening. So it seems like he's almost been kind of giving us a little bit of a pre-sale of like, hey, if I can start using the jobs market as my rationale for cutting, I'm going to do that, right? So we'll see what happens with the job data going from here. But interestingly, this data, which has seemed very contained, even some might say very suppressed for a long time, it's starting to come out of its cage.
Yeah. Again, we've, and the one thing though to remember is, and this is very important from a portfolio management perspective, is that, when we look at the employment data or the inflation data, whatever it is, we all have our personal opinions, right? Like, I don't believe that number because, this, that, or the other thing. And then that's okay. You can have your personal opinions about whatever the data is, but understand when it comes to investing in the markets, all the market care about is the official headlines. So if the like you said, the retail sales number came in better than expected, that's all the market cares about. It doesn't matter the fact that the non-seasonally adjusted number on an inflation adjusted basis was down 5%. That certainly tells us a lot about where the economy is headed, right? We need to be aware of that. But what the market's going to respond to is these official headline numbers. So it's always important just to separate, kind of our personal views from what the data says, because the market doesn't care about our personal views, only cares about what the data says.
I absolutely agree. And I think this is some of the back and forth that we have naturally, in these
Yeah.
conversations, Lance, which is um, your point, which I 1,000% agree with, is we have to deal with the market we have, not the market we think we should have or wish we had, right? But also at the same time, and I think you share this opinion, is in a market where fundamentals don't matter, like you can say we're still in right now, you still have to keep an eye on fundamentals, right?
Yeah.
Because at points they can all of a sudden jump into the driver's seat, right? And a really good example of this is, I think, what just happened with the Democratic Party, which is right up until the presidential debate, I think the Democratic Party felt like it was in fine shape, right? There's some concerns that folks have raised about Biden's, mental capacities, but those are deep fakes, those are cheap fakes. We're doing great. We're going to beat this guy. And here we are, what, 3 weeks later?
Yeah.
Right? And the entire party has basically imploded, right? And so, and it turns out there were some fundamental issues that were getting, papered over, cosmetic over, whatever. But finally, something shifted from being a non-consensus view to common knowledge, right? And that's what can happen in the market with things like jobs data, where if, and I'm not saying many of us knows for sure, but if all of a sudden the data starts revealing that, well, wait a minute, the jobs market's been a lot worse for a lot longer than we thought, and bang, unemployment's starting to go through the moon, then that can actually really change the game in the markets. So I'm right there with you. You got to trade the markets as we have them right now, but you got to be careful about where you see the risk could be, correct?
That's right. No, and look, one thing you may not know about me and Mike, because when you interview Michael E. Woods, he and I are both very bearish. Naturally, our natural personal biases is leans bearish. We're conservative. We always look at the data from a more pessimistic, point of view, and that's just human nature. That's just our personal natures, is that we tend to look towards the more pessimistic side of things because we're more concerned about losing money than making money. But that's the big challenge that both he and I have, is to set those personal biases aside and say, look, what's the data that we have to deal with, and what are the markets doing? Because we have a job, and our job is to make our clients money. That's it. And so we have to. So it's a big challenge to wake up in the morning and look at some of this data and then not go, man, I'm just going to be all in cash. So there's that bias exists in both of us. And we added some VIX hedges into our portfolios back on Monday because we were a little concerned about the market and thought a break was going to come. So we added some big. So we have a portfolio structure we run for our high net worth clients that uses options, and so we added VIX hedges to that portfolio. In our other portfolios, we were taking profits out of NVIDIA and AMD and others that we talked about already, to help raise some cash levels to reduce risk in those portfolios. But when I take a look at the overall market, my tendency is like, man, you know what? I kind of would really just rather be all in cash and bonds right now and just wait for the correction to come. The problem is that's not a great way to manage a portfolio, and you'll wind up being wrong much more often than you're right.
Well, I just want to be clearly on the record for this. I think it's understood, but I have a tremendous amount of respect for you and for Michael, because of as you're sharing here. Hey, personally, we're kind of bearish and this stuff bothers us, right? But professionally, we, for our clients, need to be the eagle, right?
Right.
And even if that's not how you feel when your foot hits the floor when you're getting out of bed in the morning, you got to put on your feathers and your beak and be the eagle for the day, right? And it's probably not unlike a judge, right? Where it's like, hey, I'm sure my gut feel is this guy did it, right?
Yeah.
But I have to apply the law fairly. Justice needs to be blind and all that type of stuff, right?
Yeah.
And because that's the right thing to do. And I we have our back and forth and whatnot, but I tremendous amount of respect for that. And it's a huge reason why I have you on this program week after week. And I'm sure you get the same slings and arrows I do sometimes, where people disagree with you on something. Why do you have that guy Lance on every week, right? And it's, because you're smart and good and you're a great model of a good financial advisor, but it's because you hold us in the audience to be honest, right, and to not let our emotions and our biases deceive us, and to try to keep the discussion at a higher level. So don't ever take any of our disagreements, which we are rare.
Oh no. No, I don't. And look, I appreciate your point of view. It was interesting. I made a mistake while I was on vacation. And after you did your interview with Mike, I made the mistake of actually reading comments in the section. I learned a long time ago never to read comments, right? Just because I haven't, I have an ego just like everybody else, and it bruises easily and those type of things. And but it's interesting because there was a lot of comments made about, oh, he's so arrogant, blah blah blah, and I'm really not. And what you may mistake as arrogance is I am confident in what I'm doing because I've been doing it for 40 years. So what may come across as arrogance, I certainly apologize if that's the way you feel, that I'm being arrogant. I certainly apologize for that. That's not intended whatsoever. But two things. One, I am confident in my ability to analyze and to manage money because I've been doing it for a long time. I've
been 10,000 hours.
Yeah. Well, look, I've been through market crashes. I've seen what that happens, and I've made massive mistakes in my past with different investments and different things that have gone horribly wrong. But that's just part of the investment process. So it's just, again, like we're talking about here, the challenge is to set aside, and look, I agree with most everything you say, right? And the only reason I counter you is because the markets are going up. And so,
just to interject, like I appreciate it because, again, I try to be as eagle-like as possible myself too. But part of my job also is to be the avatar for the viewer. So I know from feedback, from people's emails and comments, I know the worries they have. I know the proclivities they have. So sometimes it's my job to reflect that here. And I appreciate you keeping people's fears or greed or whatever from influencing to make a bad decision that over the course of your long career have a high probability of not serving their interests. So just know it's valued.
Yeah, well, no, I appreciate it. And again, I think we're kind of beating a horse here, but yeah, I just think it's important that, again, we just separate out, to your point, the markets are going to do what the markets are going to do. And as I've said before, our job is to make money. And, it's interesting because, everybody's worried about inflation, right? It's like, oh, I own this because I'm worried about inflation, and, I'm concerned about what inflation is going to do to my money and those type of things. Well, the best thing we can do to combat inflation is to invest and invest in the assets that historically have created the biggest rate of return above inflation, which is stocks. Out of all other assets, stocks have been absolutely, hands down, without a question, the best inflation hedge over the last 100 years. So, what's our job? And again, we can hate the stock market for everything that it represents, right? I'm completely with you on most of those because I think we've corrupted a lot of things in the market through passive ETFs, through changes to our regulatory environment, to a whole variety of things. I think we have completely corrupted what is supposed to be a way for people to grow money safely into a casino. But that's just what it is. We just have to understand that dynamic and invest for what that is, and understand when it's time to take money off the table and go home.
Absolutely. And, maybe, Lance, maybe we should just create our own university, because I think the thing that's done the best inflation-wise has been university tuition. So if we could just charge rapacious university tuition, we'd be crushing inflation.
Exactly.
Okay. A couple of things. First off, folks, make sure you show Lance, he's not asking for it, but make sure you show Lance some love in the comments section today. I want to make a comment in a minute about, don't let me forget, I want to make a comment about passive capital flows, because I just released an interview yesterday with Michael Green that is seminal in many ways for folks that aren't familiar with his position. But let's finish off this this Trump policy thing, just to make sure there's nothing else here.
You're missing. You haven't got to my favorite one yet.
Okay. I'm going to guess maybe that's TikTok, but let's
No,
see.
no, not TikTok. No, no, no.
Okay, so
Getting
the
it
the
wrong.
next one, which is big, um, is lower the corporate tax rate to as low as 15%. So I think that's the carrot to the stick of tariffs,
Yep.
right? And maybe I think that's to your point about how are they going to pay these higher salaries to workers. It's we're going to increase corporate profitability by not charging them as much tax,
Right.
right? Yeah.
Certainly possible. And we tried that mix before in 2018, and the market went crazy over tax cuts. So
All right. I want to know one thing here too, and it's actually been a really good discussion because it's letting me pull in all these previous ones that I've done. So if you look down here, there's an image of the Trump economic policy inner circle, and you'll see a name here, Arthur Laffer.
mhm.
So I've interviewed Dr. Laffer on this program, and his big thing is tax. But he was an economic advisor to Reagan. And if you go listen to my last interview with him on this channel, he was very positive about, hey, we can. Yeah, he's very concerned about the trajectory of where the country's economic prospects are headed, but he's very optimistic about kind of how quickly they can be turned around. And when you probe him on it, he says, "Well, I'm confident because we've done it before. I saw it happen under Reagan. We inherited this administration with just terrible trajectory and fundamentals, and through a lot of these levers, we were able to get things on a much better path, much faster than even we expected." And my sense here is that he is bringing that game plan, that game book, to Trump. And a lot of what Trump is mentioning here, those are elements that Dr. Laffer talked about. So I'm not making a pro or con comment about the strategy. I'm just saying if you want to understand it in more depth, go watch that interview with Dr. Laffer. You got something to say, Lance?
Yeah, I do. He's right. Is that Reagan did a yeoman's job of turning the economy around in the early '80s. Massive difference between today and the 1980s. When Reagan took over, he instituted a couple of things. First of all, he started doing deficit spending to get the economy back on track. They were obviously working to break the back of inflation, needed to create job growth. They also deregulated the financial industry, which allowed for all of a sudden consumers to just take on an immense amount of debt. Well, at that time, the average debt to household net worth was about 60%. Most of that was mortgages. Very few credit cards were out at that point through the general public. Today, that is vastly different because of the amount of debt that households have, both mortgage debt, credit card debt, buy now, pay later debt, which is the new thing. We've created these massive forms of debt leverage on top of the household. So the ability to consume, so the big difference in the '80s is that all of a sudden we were able to create a lot of economic growth through consumer spending because all of a sudden there was an access to all this consumer credit that wasn't available before.
Mm-hmm.
We don't have that capability now. So, and again,
We're debt saturated at this point.
right. And back in the '80s, we had very little deficit. Now we've got a $2 trillion deficit, right? We had, I don't know the exact number right off the top of my head, but we had probably, a couple of billion in government debt versus 34 trillion. So, it's just a massively fundamentally different economy that we have now versus what Laffer experienced back in the '80s. And I'm not saying he's wrong. No, look, he is a brilliant man. I'm not saying he's wrong. I'm just saying economically, if I'm going to run an experiment, right, and I want the same outcome, I've got to have the same variables. If I change the variables, I'm going to have a different outcome. Well, the variables could not be more different today than they were back in the 1980s.
Yeah, no, I don't differ, don't disagree. All right, just to bang through this because I want to get to one or two other things before we wrap up here.
Yeah. Get to my
So
favorite
Trump
one.
no longer plans to ban TikTok.
That's not it.
I don't have a real strong opinion on that. Do you? Should we?
I don't care.
Okay, all right. Okay, I don't necessarily think it's ever going to happen, but he says he'd love to have Jamie Dimon serve as the department.
That's my favorite one.
That's your favorite. Okay, go run with it, buddy.
No, I just think it's hysterical. I mean, let's just put the fox in the chicken house, right? So, you're going to take the
Yeah.
guy from the biggest bank in the world and make him Secretary of the Treasury. What could possibly go wrong with that?
Right.
So,
And it's not like the fen and the fox in the hen house where there's like 6 chickens. It's like putting the
yeah,
fox in like the Tyson's Food, chicken growing factory where there's just like 10,000 chickens in the building.
exactly. What could possibly go wrong?
Yeah. I mean, the only thing I would say there is that Diamond, he's certainly done the best job of running a massive mega too big to fail bank than anybody else. And so it's sort of like, hey, can we get that kind of competent self-interest working in our favor, right? But he'd probably find a way to.
He is a very, very smart guy. Hands down, he's a brilliant man. I don't know, just something just kind of worries me that putting the head of the biggest bank in the world in charge of the Department of Treasury seems to be a conflict of interest. But maybe I'm wrong. We'll see.
Yeah, I mean, I'm there with you. So look, I'm no fan, but I just yeah, sometimes it's like, wow, if we could just put that evil genius to better use.
Exactly.
All right, and then the last one is yeah, at least the signals he's sending about Taiwan are hey, look, we let them take our chips business from us. That was our bad, and they're thousands and thousands of miles away from us and on China's doorstep. Like, let's just rebuild the chip industry here and let those guys fend for themselves, right?
Yeah.
Don't
think that happens.
Kind of in sister element to it as well. He's of course, this is classic Trump, but he never would have had these other wars if I had been still in charge. So I'm going to end Ukraine on day one and clean up this thing in Israel. But his foreign policy, definitely is more of a laissez-faire, right? I'm going to focus much more on home. Maybe I'll be a great peacemaker in this stuff, but he seems to be a lot less. No surprise, I guess, to anybody who's saw his first term, where like it or not, we didn't engage in any new wars. He's much more like, I'm going to focus on home. And that will have implications, and probably some good, probably some bad. But any strong feelings about that?
No, I think it's right. I mean, look, look, I'm, just personally, right? If I could be president for the day, right? I would, cut off a lot of foreign aid that we do to countries that absolutely hate us for, whatever reason. And, we spend a lot of money. We regardless of how you feel about, the war between Russia and Ukraine, right? We've spent billions upon billions of dollars funding that. And I'm not saying that's good or bad, right? I'm just saying, how much good could we have done with those billions of dollars that we just spent there, solving homelessness, helping our vets, doing all the stuff that we could do, improving our healthcare system, here in the United States. And I just think, if, we have done for far too long, we've spent so much of our focus outside of our country rather than focusing internally to our country. And, so I'm kind of all for this idea that, look, bring back manufacturing. That's great. Let's figure out ways to, solve our homeless problem and help kids get a better education and improve our education system. And that pays long-term dividends to the country as a whole. If we can improve, we used to be, before 1980, when we set up the Department of Education, we were ranked #1 in the world in math, science, and education. We're now like 24th, right? So having the government take over education has not been a great idea.
Right. Same thing with healthcare. Same thing
with healthcare and a variety of other things.
Go down the list. Yeah.
Privatize a lot of this stuff. Let competition do its job, because you get better results from competition. And start spending tax dollars where it belongs. It's interesting. People always talk about Norway. It's like, we should have the Norway model. Norway spends 96% of their gross domestic product on their country.
Yeah. By the way, I've been to Norway. I love it. I'm a huge fan of them. The one thing I just want to make sure, it's easy to fall in love with the Norway model, but it's powered by a massive amount of annual oil revenue per capita. It's
no, yeah. And they have a very small population too. So
exactly.
They spend 96% of their GDP on their population. They have a very small population. They don't have 330 million people, right? But what I'm saying is that if we spent just a fraction of that money on our internal system, cleaning up Social Security, Medicare, cleaning up our healthcare system, we could do so much, make things so much better for the average American that it would pay big benefits down the road.
Well, this is, and
But again,
again,
I'm not president, so
yeah, well, I'm commenting on this stuff not in a partisan way, just because it's what's been in the news this week. But this was actually a big part of JD Vance's speech, where he pointed out that we've lost more people. Put it this way, yeah, we've lost more people in the past 4 years, I think, to fentanyl and other drug-related deaths. And basically, then we lost in America's bloodiest war, World War II. And his point was, like yours, we've sent all these billions. He was focusing on Ukraine, but said, look, if we'd taken that instead and used that to, shore up the border, stop the flow of those drugs coming into the country, and then working on rehabilitation programs and things like that, we could be doing a massive amount of internal good. And I get it, and that plays. So it's part of the appeal behind that platform. I don't want to be Pollyannish here and say, look, part of enjoying the peace that the world has had post World War II has been making sure that democracy continues to get protected and thrive around the world. And if we just ignored the rest of the world, some of that might be at risk. I'm not an expert in geopolitics, so I don't want to say I know what the answer is. I tend to be like you, Lance, much more on a non-interventionist side of things. But there is a role for foreign policy. There are battles that are worth being in. World War II being a great example of that, right? So I don't think America should be necessarily the world's policeman, but we're an important member of the global force that should be doing that, right? And where the right line is, I don't know where it is, and I don't want to get mired in trying to define it, right?
yeah, and I'm not saying, and again, just to be clear, I'm not saying we just isolate
Abandon our allies, yeah.
yeah, just abandon everybody. I'm not saying that at all. I'm just saying, hey, let's be more prudent about where we're sending money, where we're spending money, right? We send money to countries that turn around and use that for terrorism back against us. So right. That's just that just doesn't make, to me personally, that just doesn't make any sense. I wouldn't pay somebody that hated me to do things. But I think we could just be much more prudent about, we spend so much money, and honestly, the government has no idea where a lot of this money goes. We've seen the deficits in the Army's budget, et cetera. It's like, well, there's a few billion here, we don't even know where it went. That there's no excuse for that, right? We should know where every dollar is. And as a taxpayer, look, I don't mind paying tax. Look, everybody minds paying taxes, but I don't mind paying taxes as long as they're being used for good reasons, right?
Good reasons, and there's accountability. Yeah.
Infrastructure, national defense, that's the government's job. And I'm all for that, right? We need national defense. We need national security. We need global infrastructure in the US. Use my tax dollars for that. That's awesome. I want roads to drive on. I want my power to work. That's the government's job. And then let's just be more prudent about where we're doing it.
All right. Well, look, let me try to begin to close it up here. I do have a few things I want to talk with you about. One I just want to mention for folks is you were talking about passive capital flows as one of the things that concerns you just fundamentally about the market. Had a really interesting conversation with Michael Green. He's the guy that coined that term giant mindless robot, right, for these massive capital flows that just come into the market every month, and a big source of that is the buying from retirement funds, right? Mm-hmm. And I think one of the things that, I understood all this, but one of the things that became really clear to me in this conversation was, as an active manager like you, right, you can look at a company or an investment opportunity and say, yeah, I like it, I don't like the price right now, so I'm going to wait. I'm going to wait in cash until there's a better entry point, right? That doesn't happen with these passive capital inflows. They have to happen. So it is a price blind purchaser every month coming into the market at massive scale, right? So that pushes these prices up inexorably, right? Because it's like a guy going into an auction house who, whenever he gets involved in a bid, has to keep raising his bid until he's won the auction, right?
Right.
So, what Michael's claiming that's done is it's just built up a ton of really kind of phantom market cap in the markets, right?
I don't know
And
if it's not phantom. It's actually there.
well, mathematically, it's there. You can sell the stock for that much, but it's not supported by underlying fundamentals,
Oh,
right?
that's true. Yes.
Yeah. And so what you become increasingly vulnerable to is a change in those flows where that opens the door for price discovery, right?
Right. But see, this is exactly what I said earlier. And this is the big question that nobody has the answer to, is that in order to have that window open up, right, where you have this big moment of price discovery, you've got to change the mindset of everybody that's just mindlessly contributing to their 401k every month,
Mhm.
right? All of a sudden they say, you know what? I'm not going to put it into the S&P anymore. I'm actually going to sell my S&P index fund. And that's one of the things. And I don't know what causes that. I mean, maybe the market starts deteriorating a bit, and then we have some type of financial credit related crisis, and the world kind of freezes up, kind of like we saw in 2008. Then everybody panic sells, right? It's like, I don't know what this means, and they just sell everything at once. But outside of that, I don't see, like right now, if you take a look at investor sentiment, we've got some of the most bullish sentiment in the market that I've seen since the peak of the market in 2023. I mean, they are very optimistic. And they're not only optimistic about current returns, they're optimistic about returns a year from now. So, there's certainly nothing out there that would suggest that all of a sudden these people are going to start dumping ETFs in mass. And that's what it's going to take to get to this price discovery that you and I are both looking for at some point. I just don't know what catalyzes it.
So I just want to be super clear. Neither does Mike, right?
Yeah.
And Mike, he's like, look, we could have a deep enough, economic slowdown that enough people get laid off that those capital flows start decreasing, right?
Yeah.
And that could open the door. But he's like, I think 10, 15, 20 years from now, when the boomers are like, dying in mass, and their required minimum distributions get bigger and bigger as time goes on, that should trigger it. So okay, maybe 20 years down the road, but he's like, but they'll also change the rules all along the way.
Yeah.
Like they'll do all sorts of things to try to keep this game going. So like you, Lance, he's like, this is not a trading framework,
Yeah.
right? But he's like, but it's very concerning because in his mind, it's not a small amount. Like a large percentage of the market cap in the market right now is phantom, or actually I asked, is this a Ponzi? And he said, yeah, in his mind, it's inarguably a Ponzi, right? So the longer it goes on, the bigger the phantom value, the bigger the percentage of the phantom value and the absolute amount. So that risk just builds, right? So it's just, there's not a lot you can necessarily do with it today from a trading standpoint, but it's a big risk to be aware of. And so anyways,
Yeah, and I think that's key, is that it is a risk to be aware of, and that if some point something happens, and this is why we talk about risk and looking for things. I've talked about here on the show before about, if you really want to know, if there's anything to worry about in the markets, right? Pay attention to credit spreads. That's your thing.
yeah.
As long as credit spreads are not really doing anything, then there's really not a whole lot to worry about. Well, all of a sudden now we're starting to see a little bit of concern, right? Now, this
Really?
isn't anything to
Have you
go.
buried this lead? We're only
I
here at, an hour and a half in, and you're mentioning this?
Hey, well, you know what? I got to keep something for the end to make sure people watch all the way through, right? That's what the algorithms depend on. How long are people watching? But yeah, we're starting to see, credit spreads kind of, this is triple C to B, right? So this is the most extreme junk to junk. But so this is on the bad end of the spectrum of yields, but we're starting to see that kind of creep up. And again, it's not at a level right now that's of any, like, oh my gosh, I need to go get out of the market. But it's one of those kind of warning signs that we pay attention to, because again, if there's going to be an event, a market event of some sort, it's going to get reflected in credit spreads, and we'll see what happens. But it's worth paying attention to your point.
Okay. All right. Well, let's just, make a commitment here as that chart evolves, if it continues to evolve in the way of, hey, the danger indicator is rising. Let us know, because you
Yeah.
you are not the only one by any stretch on this program to say this, which is like, until credit spreads start moving, nothing's going to happen. If they're
Right.
starting to move, that could be a sign that a fuse of some sort is being lit.
Right.
All right. Well, look, I've got one last thing to talk about. Let's talk about it, and then we'll talk about your trades. Okay.
Okay.
So you were in Greece last week. I was back in New England for my father's celebration of life, which I think folks have known about. And thank you, folks, for the kind words. And as these things go, it was a nice event. Definitely very meaningful family time there, and a lot of pickleball with my siblings too, which was really fun. But one of the things there I just want to underscore. So my father, he was 89 when he passed away. He would have been 90 if he had lived to now. So nice long life. And he was a very particular, you know, investor. He was a doctor, but his real passion was investing. And one of the things he loved to invest in was early American antiques. His house, really kind of a cool house, and it's actually really hard to describe. It's kind of house you couldn't build today. Like if you go up in the attic, there are these massive timbers that you can't even wrap your arm around anymore. Like you just couldn't even get the wood to make this thing anymore. But he's got just a lot of this sort of, early colonial stuff in there. And it's super important to him, clearly. I mean, the house was his favored child out of all of his kids. We knew where we were in the pecking order, and it was pretty far below the house. So now my stepmother is, it's all fallen to her it's now her place, right? And it has all this stuff. And he, to my knowledge, certainly none of his kids, but I don't think my stepmother either. There was no plan of like, okay, when I'm gone, here's what I want done with this stuff, right? So right now it's just sitting all where it was when he was alive, right? And I think my stepmother feels like she's got this long journey ahead of her of like, how do I find the right home for this stuff that probably nobody in the family necessarily wants to keep around, right? But other folks that collect this stuff would be like, you can't just put it on Craigslist, is what I'm saying, right?
Right. Sounds like you need to call up. What's that show where the guy comes to your house and he
The
looks at
American Pickers
and,
guys, yeah, they'd
yeah,
probably
you
love it. Yeah,
call those guys.
yeah. Sadly, no like cool, Indian motorcycles or anything like that. But yeah, if you're into, whatever, the earthenware or silver spoons or, whatever. Like for example, you had the spoon set on the wall, and some of the spoons were made by Paul Revere, who was a silversmith. Like literally, Paul Revere was the guy that made
That
them.
stuff may be worth a lot more than you think.
I mean, it could be. It could be. Well, it is. Like, that's what I'm saying. You can't just put it on FreeCycle or Craigslist, right? You got to have somebody go look through it and figure out what to do with it, right? So anyways, where I'm going with this is, stepmother's wonderful and she's fine and will handle this well. But, to a certain extent, it's kind of just like, hey, here's this whole thing I put in place that was important for us. And now I'm just kind of dumping it on you and I'm out of here, right? And part of that, because I think my dad was one of those guys who just thought he was going to keep living for a lot longer, right? Even though he was pushing 90, right? People don't like to reflect on their mortality, and I think my dad was one of those guys. So I'm bringing this to investing, which is, we know, and even from the recent poll results I showed here a few weeks ago, there's a lot of people watching this video who are they are DIY. They're DIYing their own portfolios right now, right? Their own financial wealth. Some of them do that because they really enjoy it. I think from the stats, a lot of folks are doing it and they're not happy about it, right? They'd love to find someone they trust, a competent professional they trust who could do this for them. But in the meantime, they're still doing it for themselves right now.
Right.
But I'm sure you've seen this, many, many times in your career, Lance, which is, most couples have this dynamic where one takes over the financial management side of the relationship and they're doing everything, right? And the other spouse is generally focused on other things, raising the family, doing whatever, and they're not that involved. And then you
That's
have the financial
90,
manager.
that's
Pardon me?
95% of people.
95% of people, right? And then sadly, you know, I would say it's not uncommon, but you tell me, I think it's maybe more common than not. When the person managing the financial side passes away, the other person is kind of like my stepmother, like just, oh my God, I wasn't involved in that at all. Like I got to figure out what to do now. Like you had decades of expertise you built up in doing this. And now it's in my lap and I have no idea what to do. In a lot of cases, these people are now older, right? And they don't have the energy, they don't have the opportunity to go back and really get educated in this. So, it puts a lot of stress on that person, but also the family in general, or anyone else who's going to be a beneficiary of all this. So my overall point here, I want to get your thoughts on is probably better if you don't do that, right? And they're probably really good strategies, but I think one simple one would just be, even if you're happy being a DIY, like find whoever you want the torch passed to, right? If it's not going to be a member of your immediate family who's going to take over this, then find a professional or another agent that you have confidence in, and make sure your family has a relationship with them while you're still alive, so that if you suddenly are out of the picture, they're not just at a loss of what to do. They know the game plan. Oh, I'm supposed to call so-and-so, and they already have all the information, and they're going to manage it just like my spouse was managing it. And I kind of know how the game plan is going to go from here, especially because there are some pretty important financial decisions that need to be made immediately in the wake of somebody dying. So much better if you've got a trusted professional who everybody already knows helping you, guiding you through those decisions, versus you just being a babe in the woods. So this happens so often, I think, Lance, I really want to make sure I give you a chance to give your insights about it to people.
No, it's true. It's two things. One is like, we work with a lot of people that, the husband or the wife, they handle all this. And then, we get to know the kids and we wind up managing accounts for the kids, and we create that relationship because the transition part is tough. So so two things. First of all, there are advisors out there that literally read the obituaries. So when somebody passes away, they know that there's insurance money going to the spouse. So they will start, calling up the spouse like, oh, you're getting this insurance payment. You got to get this invested. Usually they're selling insurance products and some sort of annuities, et cetera.
And is that sort of like the ambulance chaser,
It is.
part of the industry?
It is. And it's part of every industry, and it's part of this industry. So you just have to be aware of that. So two really important things. One, let's just say that your spouse passes and you don't have an advisor relationship. Don't do anything for a year. Just whatever money there is, just leave it where it is. Leave it in cash. If you get an insurance payment, that's great. Put it in cash. Don't touch it for a year. And the reason is because you're going to go through grieving. You've got to deal with, the estate. You've got to deal with, the house or whatever it is. You're going to have all these other issues that are going on. The last thing you need to be worrying about is whether the market's going up or down or whatever. So just put everything in cash for 12 months and just go through your grieving process and come out on the other side of that. Then you can think a whole lot better about what to do with your money in your future from that standpoint. You're not under pressure. You don't have any, talking in your ear about what's happening. You can just start fresh at that point. Say, okay, I've got this chunk of money. I got to make it work for me. 12 months isn't going to make any difference what about inflation? Doesn't matter. 12 months isn't going to matter in that period of time. And what's more important is you don't make, and in the moment of grief, while we're trying to deal with all these other issues, that's when we make our worst financial decisions. And that's why advisors prey on those type of people, because they're very emotional. They just inherited a bunch of assets from their husband, who was very fond of ExxonMobil or whatever it was. Well, that was my husband's stock. He used to work for the company. And you just wind up making a lot of very bad decisions because you're not really thinking clearly at that point. So give yourself time to go through that grieving process. That becomes a lot easier if you have established a relationship with a good advisor, whoever it is, in advance. So if you've been, and again, I encourage you, if you're the spouse that's not involved with the finances, you don't have to be, but at least once a year, go with your other spouse to meet with a financial advisor, know who they are, put a name with a face, understand what they do, understand where they are, so that you can get to them. Because again, when it comes down to this moment of, surprise, and in most cases, deaths come fairly quickly. We're not ready for them. We're never ready for a spouse to pass. But, at that moment, you've got somebody to call and say, hey, look, this just happened. And that advisor will help you go through, okay, just relax. Let's take care of the funeral. Then we're going to go through, the estate documents. We're going to go through the insurance policies. We're going to get all this stuff taken care of. I'm going to do it for you, so you don't have to worry about it. We got you covered. That's what our job is, right? Is to help people through these periods. So if you've got a good financial advisor, make sure you know who they are. Don't shove everything off on your spouse and go, I'm not interested in it. It doesn't matter whether you're interested in the stock market and finances or else. Be interested in your money, because that's what you're going to depend on for the rest of your life. And a lot of times we just kind of slough that off as, well, my husband's got it or my wife's got it under control, and they're going to deal with it. And a lot of times they're not prepared for it either. Most people are not well suited or well prepared for a death in the family. They haven't done their estate planning. They haven't done their financial planning. They haven't done these type of things to make sure that there's not a big disruption. And again, I've seen more families destroyed post the death of a spouse. And because all of a sudden there's money there, and the kids are fighting over who gets this and who gets this, and somebody's feeling gets hurt, and before you know it, nobody's talking to each other. And I've just seen entire families just completely destroyed for years over what simple documentation would have resolved in the first place.
Well, and that's what's so tragic about it, right? Is it's so avoidable, right? And so, in addition to this, obviously, sort of general estate planning kind of fits into the same bucket too. And yeah, just helping clarify, before you go, kind of setting everybody's expectations on what's going to happen and who gets what in general and whatnot, can save an awful lot of issues down the road. But this one about, finding the person that you're going to pass the torch to, it's on a relative basis, it's a relatively easy step, and it's like such an act of love for the people you care about. Right? Like when you really think about it, not doing it is really such an act of neglect, right? It doesn't cost you anything. It doesn't take that long. But as you just said, as you've enumerated, it removes, the risk of basically tearing your family apart, right? So anyways, I do ask, kind of everybody watching this or listening to this right now, if you don't have a clear succession plan, if you are, for your relationship, whether you're the one who's managing the financial assets or not, if you're the one who's dependent on the other person, I would highly recommend prioritizing, before the end of the year. This is a goal, which is to say, okay, let's come up with a plan. And then again, let's make sure that whoever the survivor, if they're not the one who has the experience on this, that they at least have a meeting and starting a relationship with the person that the torch is going to be passed to, so that if you end up leaving this planet sooner than you hope, you can do so feeling confident that, okay, the people I care about aren't going to be disrupted negatively this way.
And one other thing that I encourage you to do is so my wife knows that if something happens to me, there's a notebook in my office, and in that notebook is everything she needs to know. And there's what's called, and I call this a love letter. So I wrote a letter to my wife telling her, something's happened to me. Obviously, if you're reading this book, something's happened to me. I love you very much. Express your, warmth for your spouse. But at the bottom of that letter is the name, address, and phone number of every important contact she needs to have. Who's the insurance company? Who's the contact? Who's our financial advisor? Who's that contact? Who is our banker? Who's that contact? Anybody that I have investments with, here's their names and phone numbers, and the contract is under tab C, tab D, whatever. So everything is there for. So in the moment of grief, again, this is the thing you don't want to saddle your spouse with, is that in that moment of grief, when they're having to deal with you leaving this world, is trying to hunt down all this information, try to figure out where their money is, right? Make it as easy as possible. Write a love letter to them, put all this information in there, tell them where it is, and make sure it's easily accessible.
So my dad was very self-directed, and in his last days, when it was becoming clear that he probably wasn't going to make it, there was such a scramble and stress on my stepmother's and to try to get into. They knew what online brokerage he was using to make his trades, but they were like, we don't know his password, right? I mean, we don't know any of this, right? So they were desperately forensically trying to figure, because at this point he was incapacitated, trying to figure out how to get in. Unfortunately, they kind of reverse engineered a way in. They got quite lucky. But to your point, like that's the last thing somebody should be dealing with, after the death of a loved one. I think the only thing I would add to what you said is, that list is super helpful, and yes, you should definitely leave that. But they should, before you die, you should be having them have a relationship with whoever the quarterback is going to be of that team, the general contractor, if you will. Like, you don't want, when you die, you don't want your spouse to suddenly have to be calling 8 different people and managing relationships with all of them. They could, but in most cases, you want to have somebody there who'll say, hey, look, I'm going to hold your hand through all this, right? And we're going to call this insurance guy that Lance had on there, and I'm going to help you through all this, because in a lot of cases, there's a lot of spouses who are like, I don't know anything about insurance or the state law or whatever, right?
Yeah, and that's what my firm, as I was talking about this the other day, is like my job is the least important job in the entire firm, which is managing the money. And it's very interesting. I get a lot of emails from your viewers, talking about, oh, I want you to manage some of my money. That's the wrong approach, right? What I do is the least important thing. It's all the other stuff that a good financial advisor does in terms of financial planning, estate planning, all these type of things. And that's why I'm blessed with Richard and Danny and John and Jonathan and the guys we have in our firm, because they're those guys, right? When something happens, they're on the phone with the family. They're driving out to flying out wherever the family is, and sitting down with them and holding their hand to go through all of this stuff. That's their job. That's what they do. And that's why. And this is the thing, we had a conversation earlier this week, is people don't understand it. And I get it, right? There's a lot of DIY investors. Like, I don't want to pay a fee to a financial advisor. Well, you're missing the whole point of having a financial advisor, which is not the portfolio management. You don't need a financial advisor to manage your portfolio. Just buy an S&P index fund and let it go, right? That's all you need to do. But it's all the other stuff, right? You don't go to a doctor to make you a better athlete. You go to a doctor to make sure you're not going to die from something, so then you can go train harder to be an athlete, right? So you need to treat your financial advisor as a professional, because that's what they are. And their job is to make sure that all your financial aspects are in the right place. The portfolio management part, trading stocks, beating a market, that is the least important thing out of everything else that a financial advisor does for you.
Well, and you know what? I know this from talking to advisors like you. When there isn't a plan put in place in advance, for those who are currently using a financial advisor. So, let's say I'm using you and you're my financial advisor, and we have a good relationship over the years, but I'm the guy in my relationship, my marriage, that is the finance guy. I die, my wife has no relationship with you. Oftentimes what tends to happen is they get hit by the ambulance chaser guy in the local area, right? And so my understanding is that more often than not, the surviving spouse switches relationships. And what I'm saying is whatever your game plan was, if you haven't prearranged the transition with your spouse, the odds are that they're going to change the game.
That's right.
And that could be good for them. But in a lot of cases, it's because they're insecure and feeling really anxious and they don't know what's going on. And so the first person, the person that sort of cozies up to them the most and whispers the sweetest things in their ear is the one that gets their assets. And a lot of times that is not in their best interests in the long run.
That's right. And because the first thing that the advisor is going to do is sell everything and put it all in something else, because that's how they generate fees or commissions, right?
It's something that they're going to make a big amount from.
Exactly. So it's always about money, and motion creates fees. And so this is, and I've seen a lot of this happen over time, is that, well, I went and visited with this person, they promised me the moon, and they don't realize how much risk they're going to take on. And then they wind up losing a whole lot of money. Right. And then they feel terrible because they just lost a tremendous amount of money that, their spouse had been, managing appropriately for, years and years. And he was the steward of that capital. All of a sudden, they wound up losing half of it because of some event or outcome that wasn't properly prepared for. And then now not only do they have lost money, but now they feel this tremendous guilt because they destroyed something that their husband had cared for or their wife had cared for so long.
Yeah, yeah. So this is why, again, I just really underscore doing this now while everybody's alive. And the relationship here is important, right? Having somebody that your spouse feels comfortable working with, but that you feel comfortable with taking over. And you just can't do that by pulling a name out of a phone book. You're going to have to talk to a couple of different people until you find one that you feel like is a good fit for you and your family. So like I said, just make that a priority to get it done this year. And again, I'm impartial who you work with as long as they're the right fit for you and your family. And I just think doing this is way better than not doing it for all the reasons that Lance has talked about. All right, Lance, we got to wrap it up. Real quick, trades.
Yeah, I'll run through the last 2 weeks real quick, just because I was gone last week. So probably I'm sure Mike didn't cover our trades with you.
He did actually, but go ahead.
Okay, so back on June the 11th, sorry, apologize. Yeah, so kind of going back, we had added to XLE and to FANG, which is Diamondback Energy. And we had previously cut our exposure to Apple and Meta in the dividend model and increased exposure to ExxonMobil and AMLP, which is a pipeline ETF that pays out 1099s. We'd added exposure to that because we kind of looking for a bit of a transition into energy. And so this week, when we kind of started getting the hint this rotation was afoot, early this week on Tuesday, we sold down AMD and NVIDIA, cut model weights there, reduced that position, both those positions. And then on the 18th, we reduced weights in Amazon, Eli Lilly, Google, Apple, Diamondback Energy, Palo Alto Networks, Walmart,
Wow.
United Technologies, and United Technologies. So it's and again, we didn't do anything drastic. All we did was just cut these positions that got very overweight. They were very extended and overbought, so we just reduced them back to target weights. So again, just took profits, rebalanced the portfolio a little bit, and just kind of pulled that in because we've had really big runs in a lot of stuff that we had bought. Like we bought Palo Alto Networks after they missed earnings. And in a couple of months, the stock was up like 25%. So just pulling that back to target weight.
Okay. And just to be super clear, to target weight, you're not going lower than target weight yet. You're just literally, you're sort of in a like, things are making us nervous enough. We're just going to take gains off the table.
Yeah. And then so the next step will be going and reducing target weights. So if we continue to see deterioration, if we begin to take out, important moving averages, if pressure starts to kind of build in the overall market, we'll start cutting actual target weights in the portfolio and going underweight equities. So we're currently about 53% equity versus 60. We're holding about 16% in cash overall because we're underweight bonds as well right now. So we've got plenty of cash buffer at this point. So when the markets are declining, we're outperforming pretty well relative to the overall benchmark because of that cash holding and because we're underweight in equities. But we have that ability to increase that cash weighting a good bit more from here.
Okay, great. All right, folks. Well, look, if the best thing that has happened to you this summer so far is that Lance is back from his adventures in Greece, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. I think we're just like a little bit more than 1,000, maybe even just 1,000 away from our 100,000 subscriber milestone for this channel. So if you're watching this, haven't subscribed yet, please do so. It only takes a second. It's free, and it'll help us hit that milestone, which will then help this channel burn more brightly on the YouTube algorithm. I'll be real brief about it this week, but look, if you want to put any of the issues that Lance and I have talked about in this now almost 2-hour discussion into play in your personal portfolios, highly recommend that most people do this under the guidance of a good financial advisor who takes into account all the issues that we talked about, maybe even Lance and his team there at RIA. Obviously, if you want to get a jump start on my advice to you about finding somebody to start, identifying who the agent that's going to take over the torch should you pass away and can be there for your family, I highly recommend that talk to the guys at Lance or at one of the at Lance's firm or at one of the firms that Thoughtful Money endorses. If nothing else, just to get a sense for what good is, and then try to find somebody even better than that if you can. To do all that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds, and the firms will be in touch with you within 24 hours. All right, Lance. It's been wonderful as always. Real quick, sorry, I don't want to forget. If you're at the thoughtfulmoney.com website, don't forget to hit the newsletter link at the top if you're not already a subscriber to our free newsletter. Two things happened this week that are meaningful for folks that are premium subscribers to the newsletter. One is, as I mentioned, I did that live Q&A with Thomas Honig, the former Fed executive. Fantastic, fascinating discussion. If you, any premium subscriber, current or new, can go listen to that. Also, this week's Macro Pass is the quarterly letter from Lacey Hunt from his firm, Hoisington Capital Management. Highly respected individual, obviously, Lacey. If you want to know what he thinks the road ahead looks like, that's what that letter answers. And to get that, just become a premium subscriber to the newsletter. All right, Lance, thanks again for coming back in general, for not staying on the beaches of Greece forever, but for giving us...
It was tempting.
I bet it was. But thanks for coming back here and being the eagle as usual. I'm going to let you have the last word.
No, it's it. Just look, don't read too much into this market action this week. Again, like I said, it was a pretty violent rotation. I'm writing about it in this weekend's newsletter at the website, realinvestmentadvice.com. But let's just see how this plays out next week, and I think we'll have a better handle on what happens next.
All right. Thanks so much, buddy. Look forward to seeing you here next week. Everybody else, thanks so much for watching.